I got to the end of the process. I walked away from the deal. I think I had some investors who were disappointed, and I had spent probably about $20,000 of my own money. And I realized at that point, if I had a partner who understood the things that I did not understand during that process, this would never have happened.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, real quick before we get started, first of all, I wanted to thank everybody for joining us on the show and for listening. To all my loyal listeners, I really appreciate you, continuing to listen and support the show. If you can go on to iTunes, Stitcher, SoundCloud, wherever you listen and subscribe to the show, that would be fantastic. Spread the word too. I'd love to, have this reach more and more people. So if you could share it on social media or and just talk about it to other people, that would be fantastic. And the last thing is if you can go onto iTunes and give us a rating review, hopefully 5 stars, that would be great as well. It just helps us spread the word more, and it helps us continue to get really good guests on the show. We've had some fantastic guests, and I just want to be able to continue to bring fantastic value to you. Go onto our Facebook page too, Pillars of Wealth Facebook page, and I'd like to hear from you as a listener of what you're doing in business, what you've got going on, what you are maybe struggling with or being successful with, and then what we can do on the show to help push you to that next level. Maybe questions we can ask our guests, maybe guests that we can get on the show to talk about certain topics, certain things that are really you're needing some extra support with. So provide for us some feedback on Facebook, and you can also share this out on social media. That would be fantastic as well. I appreciate it. I appreciate you being a either new listener or a loyal listener. I definitely appreciate it, and we will get started with the show. Hey, welcome back to Pillars of Wealth Creation. I have today Brian Hamrick. Brian, how are you doing today?
Hey, great, Todd. How about yourself?
I am doing fantastic. Well, thanks for joining me on the show. I want to give you a little bit of time to give our listeners a little bit about your background and then what you got going on today.
Sure. Well, first of all, thanks for having me on your Pillars of Wealth Creation podcast. It's an honor to be here. And you were just on my podcast. Obviously it hasn't aired yet as we speak today, but I host a podcast called Rental Property Owner and Real Estate Investor Podcast. I am primarily a multifamily and apartment investor. Currently, I have 380 units roundabout here in the Grand Rapids, Michigan area. And I've bought and sold over 450 units. Also, I'm into self-storage, own a self-storage facility with some partners, and getting into non-performing notes as well. And I am currently the president of the local Rental Property Owners Association, for whom I host the podcast, Rental Property Owner and Real Estate Investor Podcast.
Well, that's great. So when did you start investing in real estate?
Well, kind of like you, I started investing in multifamily in 2008, but it goes back before that. I read Robert Kiyosaki's book, Rich Dad, Poor Dad, back in 2000. Actually, I didn't read it. I listened to it on Nightingale Conant tapes. It was the Rich Dad's Secret set. So I can't even say I read the book, but I did listen to it on cassette tape in my car while I was driving between Los Angeles and San Francisco. But it was a real eye-opener, and I started looking into, I had a good job. I was working in the movie industry in Los Angeles, California. I was a movie marketer. I used to make movie trailers and TV commercials for films. So I was making good income, but I didn't feel as though I was really putting that income to work for me. And, Rich Dad, Poor Dad really kind of opened up my eyes to what I should be doing. So I started investing in single family homes and condos in locations outside of Los Angeles around the country. I bought in New Mexico, North Carolina, and South Carolina. Some of them were VA foreclosures, some of them were brand new build, but I was able to buy at a pretty good price. Coming from Los Angeles, everything seemed like a pretty good price. And I bought 7 of those, all of which I have since gotten rid of. I could say I probably broke even if you count all of the tax benefits that I got from owning those properties.
Sure.
But it did get the ball rolling. And in 2008, I decided, okay, multifamily, that's the way to go. And the time is now, because the Great Recession had just begun. And I saw a real opportunity at that point.
Cool. Yeah. So I want to dig in a little bit more into the multifamily before we kind of get into some other questions. This multifamily, what did you start buying? Were you buying like 50-unit apartment buildings? Were you buying duplexes? Kind of what was your first go into multifamily?
My first multifamily was a 12-unit in Heritage Hill, which is a historic area in Grand Rapids. It's very close to downtown Grand Rapids, Michigan. Historic property. It was built in I'm not sure if it's 1860 or 1870, but this property was built by a Civil War veteran. And it was kind of an undermanaged property. I bought it. At first, I thought maybe I'd manage it myself, but then I found a professional third-party property management company to do that for me. And it's just been a great investment. And it got the ball rolling, started buying more.
And so as you expanded, were you buying these properties on your own? Or are you syndicating them? How were you expanding?
Early on with the 12-unit, I was buying on my own. My wife and I were putting up the down payment. And I was able to do that for a couple more. I think I bought a 4-unit that way. This was a great recession, so you could buy things with cash. I bought a 4-unit for $21,500 with cash. Wow. I bought another 4-unit in Grand Rapids for $35,000. So it wasn't too hard to pick these up, and I was working remotely for the company that I had been doing movie trailers for in Los Angeles. So I was still making a good income at that point. But I did reach a point where I ran out of my own money and I had to bring in a partner. That was on a 37-unit that we bought very close to where, right next door to Grand Rapids, basically. It was a 37-unit, kind of a C- type property. And I put up half the down payment and my partner put up the other half.
Cool. And then from there, did you continue to partner with different people or?
Yeah. As I found properties, I had some relatives, some friends who would say, hey, I want to do this with you. So I would go out, find a property, whether it's like a 5-unit, a duplex here, another duplex, and I'd present it to my investors and say, hey, you want to joint venture on this? So that we did a lot of 50-50 joint ventures. They put up 50%, I'd put up 50%. Eventually I moved into, they put up 100% and I did all the work, which involved, finding the property and putting all the pieces in place so that we could take it down, and making sure we had the proper third-party professional management in place. So I moved to that model pretty quickly, where I put in all the work, but my investors put in 100% of the down payment. But then around 2012, 2013, I started looking into syndication. Because I knew I wanted to get into the larger apartment communities, and to do so, it would require more than just one partner. And I took some training on raising private money, and in 2013, bought our first 71-unit apartment complex.
Awesome. Well, cool. Thanks for explaining all that. Now let's talk about the self-storage and non-performing notes. You mentioned now you've got a self-storage, you're starting to do some non-performing notes. Is there a reason for that shift? Why the shift? Or maybe you're still doing multifamily, but why the shift? Are you still doing multifamily, I guess? Explain that to me.
Yeah, good question. So let me kind of go back and finish out my history there with multifamily. So in 2013, 2014, we bought a 71 unit. In 2015, actually 2014 and 2015, I bought another 207 unit apartment complex, as well as a 96 unit apartment complex in Grand Rapids. And raising millions of dollars through syndication, making sure that I could reach that the returns that I wanted to get to my investors, which is typically a 6 to 8% preferred return, and then a 15% or better annualized return. I wasn't able to find those types of returns here in my area. And when it comes to multifamily, I'm only investing in the Grand Rapids, West Michigan area. So I reached a point where those opportunities were no longer available. And I kind of sat on the fence for about 3 years, just waiting for the market to turn. And obviously it has not yet turned. So I'm not actively looking for multifamily, but probably a year and a half ago, someone came to me with a self-storage facility that they had under contract or they were negotiating on. And it was an off-market deal, mom and pop owned. And they showed me their numbers and I looked at them and I thought, wow, these numbers are really, really good. Better than numbers that I've seen for multifamily. And looked at the property with this person and I said, all right, let's make this happen. So we formed a syndication and took it down. And we've owned it for over a year. We bought it for $1.3 million. It's a 28,000 square foot outdoor drive-up type facility with the gates and the key code to get in the gate and security cameras and all that. There's also a pole barn and about I want to say 4,000 square foot office building on the lot. And just by raising rents to market and just pushing those rents and bringing some efficiencies into the management, we've increased the value to a point where we bought it for $1.3 million. We could sell it for well over $2 million today.
And did you put a lot of money into the property?
No, it was a very well-maintained, well-run facility. We put a little bit of money into security cameras. We probably spent somewhere between $5,000 to $8,000 to add security cameras, maintenance, just routine maintenance. But we do plan on spending. Here's the upside that we're gonna take advantage of here. We are going to spend about $650,000 to tear down the office building and the pole barn and put up 2 more storage buildings, adding 15,000 square foot more. By doing that, we'll probably, let's see, if it's worth $2 million now, it should be worth $3 to $3.5 million once we have those buildings up and once we have them fully occupied. So there's a lot of upside opportunity in this property.
Are you looking for more self-storage? You like
Yes,
that industry?
yes, absolutely. We have some ground up construction opportunities that we're looking at. We have some land under contract near the Ann Arbor, Michigan area, about 3 acres where we plan on doing about 48,000 square foot. It's kind of a tertiary market, but we've done a survey, a feasibility study is what they're called, to tell us, okay, here's what your competition is. Here's how much square footage is needed in this area within a 1 mile, 3 mile, and 5 mile radius. Here's how much supply there actually is, and here's how much you should build. So we've got a feasibility study. We feel pretty confident about it. And probably by the time this interview actually comes out, we'll have closed on that land and we'll be under construction.
Talk to us about, a lot of listeners are probably scratching their head wondering what exactly the feasibility study is and how could they ever find someone to do it, or do you do it, and that. So what's the feasibility study? Go through that. Where'd you find
Okay,
it?
yeah. So a feasibility study, this is something, if you're going to do self-storage, you want to look into this. This is kind of step one for us. My partner, who is much more savvy about this area than I am, he typically will look at some available land and do a kind of his own desktop feasibility study, which essentially is, okay, look at how much square footage of existing storage spaces in the area. Within a 1 mile radius, a 3 mile radius, a 5 mile radius. And call those facilities and find out how occupied they are. If they're above 90% occupancy, or if they don't have any availability, that's a pretty good indication that the area is undersupplied when it comes to self-storage space. So you want to then carry that out a little bit more. And in our case, we hired someone to do this, but they'll look at the average income per person within those radiuses, and they'll basically look at, okay, how much is available per person, how much square footage of existing self-storage space is available per person, and there's kind of a rule of thumb. It's not scientific, but there's a rule of thumb that you want to see somewhere between 4 to 7 square foot of storage space per person in a given area. If in the case of the land that we have under contract, there's only 1 to 2 square foot per person, that tells us the area is undersupplied. That plus some of the other indicators such as occupancy and availability of the existing space, can we rent a unit somewhere else, or are they full up? That tells us, okay, there's demand. There's demand that needs to be filled. And the feasibility study is quite comprehensive. We paid for another desktop study, so they didn't actually come out and drive around and go visit the facilities. But from their computer, they were able to call the facilities, talk to the other managers, get a sense of the area, look at all of the key indicators and ratios and population and city data, and give us a pretty good idea. Okay, here's what is needed. We think you should put in 48,000. In the case of the land that we have under contract near Ann Arbor, I believe the feasibility study told us that there's about 120,000 square foot of needed self-storage space in that area. And we're putting in 48,000 square foot. So we have a pretty good expectation that we'll be able to fill that.
Yeah. So you still you still could put in 70,000 more square feet and not be oversupplied.
Yes. Yeah. There's room for another 70,000 square foot, and it still won't be oversupplied. And because it's a kind of a tertiary market, close to Ann Arbor, but not close enough that it's
not right in it. Yeah.
Be in competition with. Yeah, it's not right there in Ann Arbor. We're able to get the land for a really good price, and we feel like we'll be able to really kind of control that area as far as pricing.
Cool. And then the non-performing notes, for our listeners that don't know too much about those, explain the non-performing notes and how you got involved in that.
So hosting a podcast, you meet a lot of people, and half the podcasts that I do, Todd, I actually have people come to my home studio, and we record in person. Well, about 2 years ago, I had a gentleman come in, and we talked about non-performing notes. He'd been buying non-performing notes and shared what he was doing and some examples. And I got really intrigued. I mean, I had looked into purchasing commercial non-performing notes in the past, but I really liked what this guy was doing. And I called him up after the fact, after we had done the interview and the interview had come out. And I said, hey, I'd like to know more about what you're doing and invest with you. So since then, we've purchased 12 notes together. And let me back up, and I'll kind of explain what non-performing notes are. Have you talked about that on your show?
A little bit. Yeah. I believe I had one person talk a little bit about that, but it's been a long time.
Okay, so basically, if you own your own home, let's say, and you have a mortgage on your home, that means every month you're paying on your mortgage. As long as you are paying your mortgage or note is considered to be performing. The lender who placed that mortgage with you, they consider your note to be performing. But once you stop paying, let's say for whatever reason, illness, medical reasons, you lose a job, you stop paying on that note, the lender then considers your note to be non-performing. And they have a lot of reason to want to get your non-performing loan or note to get performing again, because obviously, they're losing money if you're not paying, but they also have their banking rules, their corporate guidelines, and they can work with you to some extent to help you maybe restructure your loan to get it reperforming. But there's a lot of things they can't do because of their corporate guidelines. The other problem that they face is that the government requires that for every dollar in non-performing notes that a bank is holding, they have to have somewhere between 6 to 10 times that amount in liquidity, in cash. Yep. Reserves. So if you owe $100,000 on your mortgage and you stop paying that, well, that means the bank or the lender has to have somewhere between $600 to $1 million in cash reserves to cover your non-performing note. So they have every reason to get these notes off their books, and they will sell them for a discount, typically somewhere between 35 to 65% of the unpaid balance, which can be anywhere from 25 to 60% of the actual cash value, depending on how, what the status of the note is. But hedge funds will buy these from banks in bulk. Other investors will buy these from banks, either as one-offs, one at a time, or buy them in pools where you buy them in a group. And that's what my partner and I are doing. We've been buying some of these, mostly one-offs, at typically somewhere in that 40 to 60% of the unpaid balance. And we have more flexibility when it comes to working with the distressed homeowner. And our goal is to keep them in their home. So my partner, who does all of the phone calls and working with the lenders and the distressed homeowners, he will call them up and he'll often say, well, so, let's talk. I bought your loan. I am now the one who you're going to be making your monthly payments to. Would you like to stay in your home? And a lot of times that's the first time that these homeowners have even heard that from a lender, because lenders are bound by very strict guidelines as to what they can say and what they can't say. But once a private corporate investor, which would be like an LLC, purchases these notes, they're no longer bound by some of the corporate guidelines. I mean, there's still rules they have to follow, but they have more flexibility. So my partner, Gene, can say, would you like to stay in your home? And let's talk about what needs to happen in order for that to become a reality. Of the 12 notes that we've bought, 4 or 5 of them we've gotten to be reperforming, which means we've restructured the note in order to get the homeowner to stay in the home. Probably 4 of them we've gone through the foreclosure process, because quite often people will not come to the table or not return phone calls or say they're going to do something and then not do it. At which point we'll go through the foreclosure process. But if the profit is probably best if you can get that note to be restructured and keep that homeowner in the home, because you don't have to go through the foreclosure process. You can start making that monthly income. If you bought a note that the unpaid balance is $100,000, let's say, and they're paying 8% interest on that, but you bought that note for $50,000. Well, if they start paying that 8% interest to you, who paid half of the unpaid balance, that's actually 16% return that you're making. And if you can get them to refinance that loan after seasoning the note for a period of time, if they can refinance, well, they're going to pay you that $100,000. If you only paid $50,000 for that $100,000 note, when they refinance and that $100,000 is paid off, well, you just made 100% profit on your investment. Does that make sense?
That makes a lot of that makes a lot of sense. I appreciate you explaining that, because that's one of the questions that I had is, well, if I buy this thing for 50 now, do they only owe me 50? But they actually owe you the original note, of course, unless you negotiate with that. But you're usually probably negotiating terms, not the loan amount.
Yeah, you're negotiating terms. The unpaid balance remains the same.
Mm-hmm.
So if they owed $100,000 and you bought that note for $50,000, well, they still owe $100,000. And if they start paying interest, they're going to pay interest on that $100,000, not on the 50 that you paid for it. If you foreclose on the property, well, then you have the expense of foreclosing,
Mm-hmm.
and the actual cash value of that home might be, say, $150,000.
Yep.
So you could actually make a better profit that way. But in our case, we try to work with the homeowner as best we can.
You also have a little more risk that way too. I mean, there can be a lot of damages to the property, and if it's foreclosed and the market goes down at that time, there's just a lot of different risk to foreclosing on somebody.
Yes, the risk goes up substantially when you get into the foreclosure situation, because we have had two incidents. One where we got into the home. The owner was not living there. They had been renting it out, and the renters moved, and the homeowner basically, or the person who owned the property, had abandoned it. We got in and found some pretty serious structural damage and foundation damage. So we lost a little bit of money on that particular note. Another note, we took possession of the property right in the middle of winter in February, when we had record cold temperatures. And like the day before the day that we actually took possession of the property, the pipes froze.
Mm-hmm.
There was substantial damage to the property. So you're right. There is risk when you go through the foreclosure process. So you mitigate that risk by trying to keep the homeowner in the home.
Yep. How do you go about finding a distressed note?
Well, it's contacts. I work with strategic partners. So when it comes to the self-storage or the notes, I'm working with people who are very good at what they do and know how to find the deals, know how to find the notes, know how to talk with the lenders and the homeowners. My part is bringing in the money, but I will tell you that as far as finding the notes, my partner has spent the past 6 years building his network, both lenders, hedge fund operators, private corporate investors who tend to pick up large pools that he can then pick off what looks good to him. So it's really, he's built his network. He's taken the training. He goes to all the note conferences around the country, and he's pretty well known in that world.
Sure. Yeah. So a lot of same way you have success in a lot of other areas is it's all about networking, building relationships with the right people.
Yeah, and just getting the experience. Getting the experience and kind of understanding how things work.
So your partnership, I mean, essentially, your partner's doing a lot of the when the self-storage, they're doing a lot of that kind of hands-on, and same thing with the note, and you're probably providing some support, but one of your big assets that you're bringing to the table is being able to actually execute on the transactions by bringing the money to the table.
Yes. Yeah. So what I bring is kind of like the big picture vision, which is, all right, we can scale this much larger. I've syndicated 4 times. I'm in the process of doing my 5th syndication right now. And I know how to get that done. I know how to put together the marketing and the message and the story and tell that story in such a way that investors, typically accredited investors, want to invest with us.
Yep.
And I've spent the past couple of years looking for the right story. And when it comes to self-storage and when it comes to notes, I feel like I found the right story. But then I bring the money into the deals, make sure we can get things done. And that's what I bring to the equation. My partners bring their expertise, their knowledge when it comes to specifically managing those different types of asset classes.
Hey, I'm super excited to announce the North Star Real Estate Conference that I am putting together along with a few other friends, and we are expecting to have a great crowd there. This is going to be September 20th and 21st in Minneapolis in the Twin Cities area. And hey, it'll still be warm. And we're going to have a ton of great speakers there. We're going to have some motivational speakers. We're expecting to have speakers talking about a lot of different commercial real estate topics, multifamily and commercial real estate. So we want you there. We would love to have a great crowd there. We would love to have you there. And the cool thing with this conference is all the profits are going to benefit charity. They're going to benefit Junior Achievement specifically, who they serve underserved youth, and they bring financial education to them. They not only teach financial education, but they teach the kids how to be entrepreneurs, how to be business leaders, and how to really do fantastic things after they're out of school and moving on. So that's who we're going to be benefiting. We're going to also have a charity gala. It's going to be a fun event, and I'd love to have you attend. So again, it's called the North Star Real Estate Conference. Check it out. We've got links that we'll put on the show notes. We would love to have you there. We'd love to have you attend. Speaker lineup is coming, and that'll be announced shortly. We do have a few speakers already lined up, so you'll be able to see that. We've got Trevor McGregor will be our keynote speaker. He's a master platinum coach. So you're going to love this event. We are going to just have a ton of fun and learn a bunch, and also benefit a great organization as well. I will see you there. Check out our show notes for the links. Let's talk about finding partners for a little bit and building your teams. What are some strategies you've used to be able to find the right partners and having the right people in place to make your business successful? Because I think a lot of people do struggle with that. A lot of people they go, man, I wish I had a partner like that. Because I can't do everything. So what's been some success for you to finding the right partners, and then also just finding the right people, the team members in place to be successful?
Yeah, that's such a good question, and I don't have one specific answer, but I'll give you 3 examples. When I decided I wanted to scale up from just buying the smaller multifamilies to the larger apartment complexes, it became apparent to me pretty quickly that I needed a partner who understood the large apartment complexes. And I went out and I looked at the apartments that I wanted, the types of apartments that I wanted to own. And I said, who is managing those properties? In that case, it was a guy named Marty Green, who owned a property management company called Green Property Management. And I had met Marty before, but I brought him in his company to manage the first 71 unit property that I said that we had purchased. And from there, we struck up a partnership to buy the 207 unit apartment complex together, as well as another 96 unit apartment complex. So it was really just in that case, I deliberately went out and looked for someone who had expertise owning and managing the types of property that I wanted to buy. And that was large apartment complexes. In the other two cases, with the self-storage and the non-performing notes, it wasn't deliberate on my part. I think what helped, and maybe you can attest to this, Todd, is having the podcast. I certainly don't get paid anything. Maybe I make a little bit of money from some promotions on the podcast, but what I've benefited from hosting a podcast is the network that I built and the people who will come to me and show me deals that they want to do. And with the self-storage, I don't know how many people my partner went to before he came to me, but when he showed me this deal and I saw it and I recognized immediately, hey, this is something I want to be part of, we were able to take it down pretty quickly and efficiently. And that was just because he knew me through hosting the podcast.
Yep.
With my partner, Gene, who I'm doing notes with, the same thing. He was a guest on the podcast. I really responded to what he was doing and the way he was investing and helping homeowners stay in their home. And I called him up afterward and said, let's do some business together. So it's a little different in all three situations, but it's really just, some of it is deliberate, knowing who can help you, who you want to partner with. And some of it is just building your network and seeing what may happen.
Yeah, I mean, in both cases, you're building your network. One case, you deliberately called the person who was doing what you wanted to do. The other is, through your podcast, which those who don't have a podcast still can build their network and relationships through going to meetings and conferences and just being a part of the industry. I mean, if you're not talking to and being surrounded by people that are in the industry, you can't expect to really find any partners. It's going to be very challenging, I guess, to find partners, especially ones that have experience.
Yeah, absolutely. As far as real estate investors, we don't exist in a vacuum. There's all kinds of people out there who if we're open to partnering, we can just exponentially grow our business. I'm curious, Todd, with your podcast, if you found opportunities like the ones I mentioned?
Yeah, you definitely have had opportunities come to me. Some are great potential, some, not so much. You have to weed through them. And also it's really important. I think one thing that I've really made valuable to me is making sure the partners are the right people. And not necessarily are they bad people, but is it somebody that I think, okay, I would like to do business with them and continue to do business with them and grow with them, and do our personalities kind of mesh together? And do they have different skill sets than me as well? So that's one thing that's been something that I try to make sure works well with personalities. And again, not saying they're necessarily a bad person to do business with, or they're a bad person. It's just the relationship doesn't maybe fit.
Yeah. Does it come down to personality for you? What are the things you look for? Because I know personality is important, and I've certainly met people who seem interesting, but I can tell that we would just not get along very well.
Yeah, right. For me, I want to do business with somebody I feel like I could hang out with. And that might sound, I don't know, weird, but I want to be able to enjoy doing business with people. I don't want to do business just to make money. So if I'm going to actually enjoy doing business with you, that has some potential there. Of course, I want you to have, be ethical and honest and all that kind of stuff. That's extremely important. And then also, do you have different skill sets that you bring something to the table versus having the exact same skill sets as I have? If you've got the exact same skill sets, well, then our partnership probably isn't a really lasting partnership. Now, could we get into one deal together and, make it a buy the deal type of thing? Sure. But if we're going to be buying, doing a note buying and buying notes and continuing to do that, or buying self-storage and continuing to do that together and kind of building that business, you've got to have those things in place. Of course, always you have to have the ethical part in place.
Yeah, absolutely. Yeah, absolutely. The ethical part. I'd add two things. One would be just the experience and the skill to back up what they're promising.
Yep, absolutely.
If they say they can do something, I want to see that proved out.
Yep.
And then the other thing is just hunger. Are they hungry enough? Do they want it bad enough that when things get tough, they're going to stick it out? Because the last thing you want to do is be in a partnership with someone who's not going to stick it out.
Yeah, definitely good point there. Everybody's different. So you just, in my opinion, you've got to be careful who you do business with, and sometimes it doesn't work, and it's nothing against that person. It just doesn't work out. That relationship should be formed.
Yeah. That's funny, because you shouldn't treat it like a marriage, like you're going to be with this person forever on every investment you do for the rest of your life.
Yeah.
I believe in kind of a project by project or syndication by syndication partnership. And I think that it's a fluctuating partnership, depending on what the asset class is and who brings value to the partnership structure.
Yep. No, I definitely agree with that. Well, let's talk a little bit about your business and how some key fundamentals to operating your business successfully. Because one thing that this show I try to kind of press upon people is that a lot of people in real estate think of it as being a transactional business, right? Where we got to buy an apartment building, we got to buy a house, we got to whatever. And they don't think of it as a business, as operating a business. And so that's kind of what this show is all about, is to try to go, hey, we're not just real estate buyers. We are real estate business owners. Real estate is our product. So what's some advice you would give to our listeners about successfully operating a business? Maybe 3 things.
Wow. Okay. Well, so I'm different in some respects from people who own large apartment communities, in that I have built a team, but I do not have any employees. So I'm really just a one-man business. Hamrick Investment Group is the name of my company, and it's basically just me. But I have built a team, and that team consists of many different companies and individuals. One of those individuals is my bookkeeper, who pays all my bills, oversees a lot of the finances on my properties. I have a third-party property management company that's actually owned by my partner, Marty Green, and I work with them quite a bit to make sure that our properties are healthy and running the way they should. I have a loan broker who I can call and get information from. I have brokers that I work with, a CPA who does all the taxes on my properties. So without having employees, I feel like I do have a team, and I try to get that team to work directly with each other as much as possible. My feeling as a business owner is that I don't want to be the bottleneck or the person stuck between the conversations that need to be happening. I want the different parties to be able to communicate directly with each other. So I've gone to great lengths to make sure that all my different team members, and also I forgot my insurance agent, who I rely on quite a bit. I want them all to be able to communicate directly with each other. So I'm not the one in between running back and forth trying to figure out what everybody needs. I think weekly definitely monthly reviews of all the finances on the properties, looking at the profit and loss statements, the rent rolls, the delinquency reports, the unit vacancy reports. That is something that I need to do, because no matter how much I trust my team, the numbers tell the story. So you can always look at the numbers and say, you know what, our delinquencies or tenants who aren't paying their rents are too high. What's going on this month? Why aren't we on top of that? So definitely staying on top of the finances. And I know you asked for 3, but I'm blanking on what the third one might be.
That's all right. We'll move on.
Yeah, it'll come to me.
Yeah, it'll come to you. That's all right. So next question: what's a big mistake that you've made, or just a mistake that you want to talk about, and how have you learned from that?
Big mistake, and how have I learned from it? I think early on, the first syndication I tried to do, I ended up not going through with that deal. There was just too many problems that kind of came up at the last minute, and I had backed out. But the mistake I made on that was bringing my investors in too early, getting them excited about this property, getting their some of their financial information in place with the lender and the broker to make sure that we could follow through on the sale, and not having the team and the experience in place to know that I was going down the wrong road. So at the end of this process, and I had tried to take down this apartment complex myself. This was over 100 units here in the Grand Rapids area. This was early on. It was going to be the first syndication I did, and I did not have a partner. And I got to the end of the process. I walked away from the deal. I think I had some investors who were disappointed, and I had spent probably about $20,000 of my own money to get to the point where I had gotten. And I realized at that point, if I had a partner who understood the things that I did not understand during that process, this would never have happened. And that's why I went out and I found a partner, Marty Green, to be my strategic partner when it came to investing in apartments.
Yeah, no, and the partnership aspect is or the team aspect, however you want to position yourself, but that's really important, especially when you're first starting. I think there's just so many different aspects. Multifamily is, people say, well, you can it takes the same time to buy a single family than a multifamily. Well, maybe that's true, same effort. Maybe that's true, but there's just so many different things in a multifamily, so many things you need to be careful about. And there's a lot more money at stake, and it's investor money oftentimes. So there's just so much more, in my opinion, that you need to be aware of, and that partners can really help avoid a lot of those mistakes. Like you said, you probably wouldn't have went down that road or nearly as far, and wouldn't have lost the money, wouldn't have got your investors excited, had you had the right partner in place on that deal in the first place.
Absolutely. And I realized, because I had several smaller multifamily properties at that point. And I figured, okay, it's not that far of a leap to go up to a larger apartment complex, but it was, and I should have had the right people in place with me. And those were different people than who would help me build the smaller multifamily portfolio.
Yep.
So there was a difference in the type of person that I needed by my side.
Yeah. Yeah. I think that's definitely a ton of value right there that you just talked about. So take us through the mind shift that you had. You were an employee. What was that mind shift like of becoming an investor? Was there any like aha moments, or what was it?
Wow. I never felt like an employee. I had I had great jobs. I mean, I loved the jobs that I had. I worked for great companies. I did not feel like an employee and that I was dependent on my employer. I knew that if they fired me or if I got let go, I could go find another job and be just as fine. But the mind shift was really, well, first of all, it was just a great sense of freedom and relief to not be bound to a certain schedule or have to take phone calls and do. Yeah, I'm living in Michigan and I was working for a company in California. There was a 3-hour time difference. So I wouldn't start working until, say, 12 o'clock in the afternoon, but I'd be working till 9 or 10 o'clock at night. So just that freedom of not having to work so late was key. There's definitely you're a different person when you're an entrepreneur or a full-time real estate investor. I think you're busier. I'm certainly busier than I ever was when I had a job, but I also feel like I can do it on my own schedule and do it on my own terms, which is a lot better. And I think some people have a problem with that because they're not as self-motivated as you need to be an entrepreneur or a real estate investor. And maybe they end up being frustrated because they don't know how to direct their time and direct their own efforts. They're used to having an employer tell them how to direct those efforts. But I love it. I love having that freedom and of choice and being able to determine what I'm going to do and when I'm going to do it.
So I just came up with your third tip for operating a business successfully, and that was you must be self-motivated.
Absolutely. Absolutely. You have to be self-motivated. You won't have a boss sitting there saying, good job. I really like the way you handled that. Or directing you on how to do it better. You're on your own.
Absolutely. See, we knew it. I knew it would come out. We just needed to fill in the blanks there. So we got to take care of it.
Thank you. You can edit that. So that
Perfect. So I asked you how to operate a business successfully. I want to know then, what are some factors for your success? What do you do to make sure you're being successful on a personal level? And a personal business level, yeah.
On a personal business level?
Personal and business level, yeah. What are you doing for yourself to make sure you're successful?
Well, on a business level, I stay involved. I network. I try to give back, and I do that through. Currently, I'm the president of the Rental Property Owners Association. I sit on multiple committees, the education and conference committee. Every year we have a huge conference. It's the largest conference in the Midwest for real estate investors right here in Grand Rapids, Michigan. So I'm on that committee. I'm on the education committee. I teach a class for the RPOA. And these are all things that I don't get paid for. I mean, anybody who is a volunteer for the RPOA is doing it for other reasons. But you're giving back. You're helping other investors learn what you've learned. Sharing those experiences and then also networking with some really great people. So from a business perspective, I consider that to be one of the greatest ways. And that extends to the podcast, to the Rental Property Owner and Real Estate Investor podcast that I host. We get a little bit of sponsorship income from that, but it's really more of a kind of a passion and hobby for me than anything else. What else do I do for business? I do a lot of lunches, a lot of coffees with people. I'm very available for people to call me or try to get in touch with me. I try to get back to people as soon as possible. I try to answer any questions that people might have. And I get a lot of questions from kind of new investors, new or somewhat new investors who are looking to take that next step and get to the next level. From a personal standpoint, I have 2 kids and my wife, and I try to do as much with my family as possible. My mornings, my day is kind of scrunched between getting my kids off to school and then when my kids come home from school. So I try to get everything accomplished between 10 a.m. and 3 p.m. during the day, with a little bit of work in the evenings, but I try to keep it as sane as possible. And I think I'm doing a good job.
Your schedule sounds very much like mine. I get my kids on the bus every morning. I get my, they come home, and that I'm home for them. So, yeah, sounds a lot like my schedule. You do a little bit of work in the morning, and do a little bit of work in the evening after they go to bed. So,
yeah, but as I think we both know that you're always working. You're always on, because even if you're driving your kids to school, you might be taking a phone call.
yeah,
You might be thinking of what you need to say to this person, or how you need to respond to this email. So we're always working, but we may not physically be in front of our desk.
very good point. Okay, a couple more questions before we wrap up. You've already mentioned a book, but what's a favorite book that you can recommend to our listeners?
I just met a guy. I joined Rod Cleef's multifamily boardroom.
Okay.
And the networking in that room is incredible. I met a guy named Brian Murray, who wrote the book Crushing It in Apartments and Commercial Real Estate. So he just sent me this book, so I'm really looking forward to reading it. So I'll give it a plug on your show. And the one I really recommend that really started me off was Buying and Selling Apartments by Steve Burgess. That's one of my favorites, and as well as Emerging Markets by David Lindahl.
Cool.
And then just for pleasure, I love Jack Reacher books, and I love Harry Bosch books, the Michael Conley Harry Bosch series.
Awesome. Always good to hear what people are liking to read. So last question I have, this is one I ask all my guests, and I don't prep them for it typically. So we'll see what comes out.
But by the way, I haven't really been prepped for any of your questions. So.
Yeah, I don't prep any, but I like that because I don't want you to be pre-recorded, basically. So
yeah, I didn't rehearse any answers, but I appreciate that. I like the spontaneity of it.
Yeah. So the last question is, what are your 3 pillars of wealth creation?
3 pillars of wealth creation. Well, wow. Okay. That's a good question. I would say creating cash flow, of which I would say that what I used to make in my job, I'm probably about halfway there with the cash flow that I receive each year from my properties. So I'm building that cash flow every year. Excuse me, whether it be through the self-storage that we're doing, asset managing my existing multifamily to get it to perform better. It's all about creating that cash flow that I'm living off of. Then there is building the long-term assets and the long-term legacy wealth, which would include acquiring new properties. Right now, we're looking at the self-storage, building self-storage. So those will be long-term holds, hopefully, over a period of time. And then there's the paydays. And by paydays, I mean things like when I refinance a property and I'm able to pull cash out. I'm a net seller at the moment, so I've sold a couple properties. That's a nice payday. The notes themselves, working on the notes, that to me is a payday because we get some pretty nice returns off of that, but it's not long-term returns unless in some cases we hold on to those notes and continue to collect payments. In most cases, we're disposing of those notes and taking the profit and creating that velocity of money by rolling that profit back into more notes. And that's creating paydays for me. But at the moment, it's not creating the long-term wealth. And I hope to turn it into that at some point, but currently it's more of a payday. So I guess the cash flow, the long-term legacy wealth and asset appreciation, and then the paydays.
Perfect. Great answer. So last thing is our listeners, I'm sure, want to hear your podcast, get in touch with you. Where can they find you?
So you can find me by going to my website, which is higinvestor.com. That's HIG Investor, INVESTOR.com. You can get all my contact information there. My email is brian@higinvestor.com. That's BRIAN @HIGinvestor.com. And the podcast that I host is the Rental Property Owner and Real Estate Investor Podcast. And you can find it anywhere on iTunes, Stitcher, Google Play, wherever you listen to podcasts.
Cool. Well, Brian, appreciate you spending a lot of time with us and tons of value here. So I appreciate it, and have a good rest of the day.
Yeah, thank you, Todd. I really enjoyed being on your show. This was a lot of fun.
Hey, special thanks to Brian Hamrick for joining us on the show. Appreciate his time and a ton of value that he was able to add to us. And just a couple key things I took from this episode. First of all, he talks about reviewing your key financials often, making sure you understand what's going on inside of your business. The key financials are obviously key, and you want to make sure you're staying up to date with those. The other thing he talked about, and we hear this one over and over, is make sure you build a team. He talks about finding partners by asking who's doing what you want to do. So finding others that are kind of in the same spot as you, or doing what you want to be doing, and be able to partner with them. And the last thing he talks about is just being able to stay self-motivated. And being an entrepreneur can be a fairly lonely business. A lot of times we're kind of in it ourselves. We might have team members, we might have partners, but we still have to stay very much self-motivated. And I talk about that quite a bit with those who I am mentoring, about staying self-motivated, also by finding other people that can help kind of hold your feet to the fire. Extremely important with that as well. So again, appreciate Brian joining us on the show and the time he was able to spend with us. I hope you took at least one thing from this episode. Write that down and really focus on it this week, and make sure it becomes a part of your daily or weekly routine, and something that can really push you forward in the end and get you to where you want to be. I'm Todd Dexhammer. I'm signing out. Make every day a Saturday. Hey, thanks for listening to the show. Couple things before we go. Again, go on to our Facebook page, Pillars of Wealth. We'd love to have you on there. Go on to iTunes, give us a rating and review, and subscribe to the show. Also, don't forget, reach out to me if you want any help with potentially growing your business, and reach out to John Stiles to help you buy or sell real estate. Thanks for listening. We appreciate it. Have a fantastic the rest of the day. And as I say, make every day a Saturday.